Now we have unit 2, the Keynesian theory of determination of national income. Here we have learning outcomes, then we have unit overview where we will be covering the Keynesian theory of determination of national income, which has the two sector model for national income determination. Then we have the investment multiplier. Then we have the determination of equilibrium income, three sector model, and lastly four sector model. So here is the introduction. In the previous unit on national income accounting, we have discussed the importance of GDP to estimate the macro fundamentals of the country. So in this unit, we will focus on two issues, namely the factors that determine the level of income, just make it mark, and the determination of equilibrium aggregate income and output in an economy. So the Great Depression of the 1930s was the greatest economic crisis the Western world had experienced. The classical economists of the time had no well developed theory that would explain persistent unemployment nor any policy prescriptions to solve the problem. Many economists then recommended government spending as a way of reducing unemployment, but they had no macroeconomic theory by which to justify their recommendation. So the history of modern macroeconomics was revolutionized in 1936, mark is 1930, after 6 years, with the publication of John Maynard Keynes' General Theory of Employment, Interest and Money. The general theory of employment, interest and money was more than a treatise for economists. It offered clear policy implications and they were in tune with the times of the Great Depression. The Keynes introduced many of the building blocks of modern macroeconomics. First, the relation of consumption to income, I will mark it, and the multiplier, which explains how shocks to aggregate demand can be amplified and lead to larger shift in output. Then we have liquidity preference, the term Keynes gave to the demand for money, which explain how monetary policy can affect interest rates and aggregate demand. And third, the importance of expectation in affecting consumption and investment, and the idea that shifts in expectation are a major factor behind shift to demand and output. The Keynesian theory of income determination is presented in three models. First, the two sector model consisting of the household and business sector. Second, the three sector model which includes household, business and government sector, and the four sector model which has household, business, government and foreign sector. Before we attempt to explain the determination of income in each of the above model, it is pertinent that we understand the concept of circular flow in an economy, which explains the functioning of the economy. Circular flow in a simple two sector model. So concept of circular flow. The circular flow model demonstrates how money moves through society. Money flows from producers to worker as wages and flow back to producers as payment for products. So it works this way. This is called circular. Means you give money to someone, he will pay to some other service, and the money will start flowing in a circular manner. In short, an economy is an endless circular flow of money. This is the basic form of the model, but actual money flows are more complicated. Economists have added in more factors to better depict complex modern economies. These factors are the components of a nation's GDP or national income. For that reason, the model is also referred to as circular flow of income. Mark this. The basic purpose of the circular flow model is to understand how money moves within an economy. It breaks the economy down into primary two players. First, households, and second is corporations. It separates the market that these participants operate in as markets for goods and services and the market for the factors of production. Households own all factors of production and they sell their factor services to earn factor incomes which are entirely spent to consume all final goods and services produced by the business firms. So the spending of household is to business firms. The business firms are assumed to hire factors of production from the households. They produce and sell goods and services to the household and they do not save. Mark this, they do not save anything. Means 100% of earned is 100% of. There are no corporations, corporate savings, or retained earnings. The total income produced Y accrues to the household and equals their disposable personal income. Means whatever is earned is 100% spent on various things. In the figure 1.2.1, the circular flow of income and expenditure which presents the total working of the two sector economy is illustrated in a simple manner. So figure 1.2.1, circular flow in a two sector economy. So here is a household and here are the firms. So the firms gives factor payments, that is wages, rent, interest and profits to household, and the household, I think household consumes this expenditure, means whatever is earned. Firstly, this gives services, could be goods and services. In return of that, the firms give payment in the form of wages, rent, interest and profit. The same money is again spent 100% for buying these goods and service to the firms. So this is a circular flow. We have then this, the circular broken lines with the arrow shows, just a minute, I will make it little visible. The circular broken lines with the arrow shows factors and product flow and present real flow, and the continuous line arrow, this is continuous, shows money flows which are generated by real flow. Real flow refers to the flow of actual goods and services, while money flows refers to a payment for the service, could be wages for example or consumption payment. There are no injections into or leakages in the system. Since the whole of household income is spent on goods and services produced by firms, household expenditure equals to total receipt of the firm, which equal the value of output. So factor payments equals to household income equals to total expenditure, means household expenditure equals to total receipt of the firm, and that is equal to value of output. Before we go into the discussion on the equilibrium aggregate income and change in it, we shall first try to understand the meaning of the term equilibrium, defined as a state in which there is no tender to change or a position of rest. Output is at equilibrium level when the quantity of output produced equals to the quantity demanded, means center point equals. Logically, an economy can be said to be in equilibrium when the production plans of the firms and the expenditure plans of the household matches. Having understood the working of the two sector model and the meaning of equilibrium output, we shall now have the formal presentation of the theory of income determination in a two sector model, which is the simplest representation of the key principles of Keynesian economics. In the theoretical model of an economy, the ex ante value of different variables should be our primary concern. Before we discuss the Keynesian theory of income determination, let us look at the basic concepts, definitions and functions used in his theory of determination. We have basic concepts. First, the basic concepts and functions. First, aggregate demand function. Aggregate demand, AD, is what economists call total plan expenditure. In a simple two-sector economy, the ex ante aggregate demand for final goods and or aggregate expenditure consists of two components. First, ex ante aggregate demand for consumption, ex ante aggregate demand for investment goods, which is denoted as C and I. So here AD equals to C plus I. Of the two components, consumption expenditure accounts for the highest proportion of the GDP. In a simple economy, the variable I is assumed to be determined exogenously and constant in the short run. Therefore, the short run aggregate demand of a function can be defined as AD equals to C plus I, where I equals to constant investment, constant, mark this. From the equation, we can infer that in the short run, AD depends largely on the aggregate consumption expenditure. We shall now go over the discussion on consumption function. The consumption function. Consumption function expresses the functional relationship between aggregate consumption expenditure and aggregate disposable income. Mark this: consumption expenditure, disposable income, which is expressed as above. C is a function of Y, where income is low. When income is low, consumption expenditure of household will exceed their disposable income, and household will save. They will either borrow money or draw from their past savings to purchase consumption goods. If the disposable income increases, the consumer will increase their planned expenditure, and current consumption expenditure will rise, but not by less than the increased income. Means the proportion will be not same. The specific form of consumption income relationship termed the consumption function proposed by Keynes is as follows: C equals to A plus BY. Again we have MPC equals to delta C divided by delta Y, that is equal to B, where C equals to aggregate consumption expenditure, Y equals to total disposable income, A is the constant term which denotes the positive value of consumption at zero level of disposable income. Mark this. And the parameter B, the slope of the function, this is called slope. Is the marginal propensity to consume, MPC. The increase in consumption per unit, increase in disposable income. So it's calculate the above. Then we have the Keynesian consumption function, where we have C, Y, this is slope B, and this is C is equal to function f of y. The consumption function shows the level of consumption C corresponding to each level of disposable income Y, and is expressed as a linear consumption function shown in the line marked C equals to this one in figure. The Keynesian assumption is that consumption increases with the increase in disposable income, but the increase in consumption will be less than the increase in disposable income, that is B will be less than 1, that is B will be in between 0 to 1. The fundamental relationship between income and consumption plays a crucial role in the Keynesian theory of income determination. Then we have relationship between income and consumption. Just as the MPC, marginal propensity to consume, the average propensity to consume is the ratio of consumption depending income consumption relationship. The ratio of total consumption TC to total income is also known as average propensity to consume, APC. Earlier it was MPC. So average propensity to consume equals to total consumption divided by total income, also denoted as C divided by Y. The table shows the relationship between income and consumption. Well, 1.2.1 which shows relationship between income and consumption. So we have income in crores, 0, 100, 200, 300 and above. Similarly we have consumption and we have savings. So in first case the income is 0 while the consumption is 50, so we have negative savings, means we will here APC equals to CY, which goes to infinity, and MPC can't calculate, so since we have a single value. Similarly we have values and the savings are as above, negative 50 crores, negative 25 crores, then 0 where income equals to consumption. This is called equilibrium point. Here APC equals to 1 and marginal is difference between this one. Similarly we have for 400 and 500, you can go through it. So the conventional Keynesian MPC is assumed to have a constant value less than 1 and usually greater than 0.5. So it falls between 0.5, just a minute, it falls between 0.5 to 1. APC is calculated at various income levels. It is obvious that the proportion of income spent on consumption decreases as income increases. What happened to the rest of the income that it is not spent or consumption? If it is not spent, it must be saved, because income is either spent or saved. There are only two options. There are no other uses to which it can be put. Thus, just as consumption, saving is a function of disposable income. So saving is function of Y, that is of income. The relationship between income, consumption and saving. Saving is also a function of disposable income. The saving function shows the functional relationship between national income, that is equals to disposable income in two sector model and saving. So S equals to function of Y. Similarly, we have a table which shows relationship between income, consumption and saving. So we have disposable income 0, 60, 120, 180 to 40. Similarly, we have consumption and we have savings. In first two cases it is negative, then it is 0, it is as it is called equilibrium, and then so on. Similarly, we have a diagram which is called figure 1.2.3. This is upper one, the consumption and saving function. So we have consumption, saving. So there is a point we call it as equilibrium, and if we plot the data, it will be in a similar lines. In the figure 1.2.3, the consumption and saving functions are graphed. The saving function shows the level of savings at each level of disposable income. We know that consumption at 0 level of income is positive, equals to A, and as such there should be this saving also of the same magnitude. By definition, national income equals to, that is Y, equals to C plus S, consumption plus savings. Therefore, saving equals to Y minus C, income minus consumption. The slope of the saving function is the MPC, marginal propensity to save. If 1 unit increase in disposable income leads to an increase in B units in consumption, the remainder 1 minus B is the increase in saving. The MPC is the increase in saving per unit increase in disposable income. So MPS equals to S equal to 1 minus C. Saving is an increasing function of the level of income. In other words, saving increases as income increases. So MPS equals to delta S divided by delta Y, that is equals to 1 minus B. MPC, marginal propensity to consume, is always less than unity but greater than 0. That is 0, it falls between 0 to 1. Also, this is one of the important things. MPS plus MPC equals to 1. We have MPS also falls between 0 to 1. Thus, saving is an increasing function of the level of income, because the marginal propensity theory MPS equals to 1 minus B is positive. That is, saving increases as income increases. So both have a positive relationship. APS, average propensity to save. The ratio of total saving to total income is called average propensity to save. Alternately, it is that part of total income which is saved. So APS equals to saving divided by income, that is equals to S divided by Y. Then we have aggregate supply. Ex ante or planned aggregate supply is the total supply of goods and services which firms in a national economy plan on selling during a specific period of time. It is equal to the national income of the economy which is either consumed or saved. So here AS equals to C plus S. Then we have some numeric examples. I will just go through it in a fast manner. First, what will the value of APS to save when C equals to 200 and Y equals to 1000? Similarly, S equals to 450 and Y equals to 200. So we will be just putting it in the formula. APS is equal to S by Y. S is equal to Y minus C. So it will be 800 and APS equal to be 0.8. Similarly, in second case it will be 0.75. Then comes the two sector model of national income determination. In this section, we will determine the two sector model of determination of equilibrium level of output and income. in its formal form using the aggregate demand function and the aggregate supply function. The equilibrium level of income and output in the Keynesian framework is that level at which aggregate demand C plus A and aggregate supply C plus S or output are equal. In other words, investment is equals to saving. Then we have the formula for that: C plus I equals to C plus S or I equals to S. So determination of equilibrium income, two sector model. So aggregate demand, we have aggregate savings or investment, just like earlier. In figure 1.2.4, the aggregate demand curve is linear, that is, and positively slope positive side, that indicating that the level of income rises as the aggregate demand or aggregate spending in the economy also rises. The aggregate expenditure line is flatter than the 45-degree line because as income rises, consumption also rises, but by less than the increase in income. So the percentage is not same. The 45-degree line illustrates every single point at which planned aggregate expenditure measures on the y or on vertical axis is equal to planned aggregate production, which is measured on the y or horizontal axis. In other words, all points on the 45-degree line indicates the aggregate expenditure equals to aggregate output, that is C plus I is equals to C plus S. Therefore, the line maps out all possible equilibrium income levels. From the point below, the 45-degree line, planned aggregate expenditure is lesser than GDP, and for all points above 45-degree line, planned expenditure is greater. So first case is lesser one, second one is a greater one. We would like equilibrium to occur at potential GDP, that is at the level of full employment. Only at point E and the corresponding equilibrium levels of income, point E, I will show you here. This is the point E. Only at point E and the corresponding equilibrium levels of income and output Y does aggregate demand equals to output. At this level of output and income, planned spending precisely matches production. You may bear in mind the basic point. According to Keynes, aggregate demand will not always be equal to aggregate supply. Aggregate demand depends on the household's plan to consume and save. So aggregate supply depends on the producer's plan to produce goods and services. In other words, aggregate supply represents aggregate value expected by business firms and aggregate demand represents their realized value. For the aggregate demand and aggregate supply to be equal so that equilibrium is established, the household's plan must coincidence with producer's plan. At equilibrium, expected value equals realized value. However, Keynes held the view that there is no reason to believe that. Consumer's consumption plan always coincides with producer's production plan, and the producer's plan to invest matches always with household's plan to save. Putting it differently, there is no reason for C plus I and C plus S always be equal. The investment function I is shown in plan B of the figure. Equilibrium planned investment as equals saving. So planned investment equals saving. Above the equilibrium of income Y, savings, the distance between the 45-degree line and the consumption schedule exceeds planned investment, while below equilibrium level of income, planned investment exceeds savings. The equality between saving and investment can be seen directly from total income accounting. Since income is either spent or saved, Y equals to C plus S. Without government and foreign trade, aggregate demand equals consumption plus investment, that is Y equals to C plus I. Putting the two together, we have C plus I equals to C plus S equals to C plus I, or S savings equals to investment. If the leakage are greater than the injections, the national income will fall, while if injections are greater than leakages, national income will rise. The national income will be in equilibrium only when intended saving is equal to intended investment, that is S equals to I. If there is any deviation from equilibrium, that is planned saving is not equal to planned investment, the process of readjustment will bring the economy back to equilibrium. So we have now equilibrium with employment or inflation. An important point to remember is that Keynesian equilibrium with equality of plan, aggregate expenditure and output need not take place at full employment. So if the aggregate expenditure intersects at 45-degree line at the level of potential GDP, then there is a full employment equilibrium. There is no recession and unemployment is at natural rate. But there is no guarantee that the equilibrium will occur at the potential GDP level of output. The economy can settle at any equilibrium, which might be higher or lower than the full employment equilibrium. Mark this. Then we have deflationary gap. If the aggregate demand is for an amount of output less than a full employment level of output, then we can say there is a deficit demand. Deficit demand gives rise to a deflationary gap or recessionary gap. Recessionary gap, also known as contractionary gap, arises in the Keynesian model of the macroeconomy when the equilibrium level of aggregate production achieved in the short run falls short of what could be achieved by produced at full employment. Recessionary gap occurs when the economy is at business cycle contraction or recession. So we have demand, we have deficient demand, deflationary gap, figure 1.2.5, where we have aggregate demand, output and income. This is a 45-degree point, this is the equilibrium point, and this gap is known as deflationary gap, which is explained above. So this OQ is full employment level. Then we will go start reading theory. In figure, OQ is the full employment level of output. For the economy to be at full employment equilibrium, aggregate demand should be at Q multiplied by F. So Q multiplied by F, this one. If it represents a situation of deficient demand, the resulting deflationary gap is Fg. Firms will experience unplanned build-up in inventories of unsold goods, and they will respond by cutting production and employment, leading to decrease in output and income until the underemployment equilibrium is reached. I will show this. So they will start reducing production due to inventory, unsold inventory, till the point it reaches here. Similarly, we have inflationary gap. So if the aggregate demand is for an amount of output greater than full employment level of output, then we can say there is excess demand. Excess demand gives rise to inflationary gap, which is the amount by which actual aggregate demand exceeds the level of aggregate demand required to establish full employment equilibrium. This is a sort of gap that tends to occur during a business cycle expansion growth phase and sets in motion that will cause demand pull inflation. Similarly, we have this one. Current now we are here and we aims for this, and the gap is called inflationary gap. So in this figure, the economy will be at full employment level, F equals to O into Q, this one full employment level of output and income. Suppose the aggregate demand is for Q multiplied by G, there is excess demand and resulting into inflationary gap F by G. I have just shown you. So suppose the aggregate, this is aggregate demand, OG, aggregate demand, this plus this, and the gap is inflationary gap. So the real output will be constant, but the rise in the price level will cause an increase in nominal output until a new equilibrium is reached, which is a point E, this one. Point E is a equilibrium point because the aggregate demand ME, this one, new one, is equals to output OM. So this equals to this. At a new equilibrium point, real output, real income and employment will be the same. Nominal output and income has increased due to inflation. In the Keynesian model, neither wages nor interest rate will decline in the face of abnormal high unemployment or excess capacity. Therefore, output will remain at less than the full employment rate as long as there is insufficient spending in the economy. Keynes argued that it is precisely what was happening during the Great Depression. So this is ideal case of Great Depression. Then we have a short numerical on it. So calculate MPC and MPS from the following data: national income, autonomous consumption expenditure, investment expenditure. So we will be putting into formula y equals to C plus I. Then we will get C. Similarly, we will get B, and the answer is MPS equals to 1 minus MPC equals to 0.16. Similarly, we have one more example where y equals to 1500. Then we have one more illustration. Suppose the consumption of the economy is given equals to C equals to 20 plus 0.6y and investment is equal to I equals to 10 plus 0.2y. What will be the equilibrium level of national income? So as we know, y equals to C plus I, we will put it into it. We will get the value of y, and we have y minus 0.8, y is equal to 30 given. Therefore, y equals to 150. Similarly, we have more examples. I will just go through in a fast manner. Suppose the consumption function is that find out the equilibrium level of income, consumption and savings. So we have the above income, consumption and saving. Similarly, one more. I am just going through it, hoping that you should or you must solve it by in a handwritten manner practically, and not just do auditing, which I am doing right now, at least once or twice. Similarly, we have seventh one. If saving function is s equals to minus 10 plus 0.2y and the result is, what will be the new level of income and output? So s plus I. Then we will put the data. Then we will get C. And now since the investment is increased, the I will be newer one. Will 55. So we will again put the data. Then we will get C equals to 270 crores. So given the empirical consumption function, calculate consumption expenditure at equilibrium level of national income. Similarly, we have more questions. Then comes 2.5, the investment multiplier. So in this section, we will develop an answer of the following question: by how much does one unit increase in autonomous spending raise the equilibrium level of income? There appears to be a simple answer. Since the in equilibrium income equals aggregate demand, it would be assumed that a unit increase in autonomous demand or spending should raise equilibrium income by 1 unit, but this is not correct. In fact, the effect of increase in investment, that is upward shift in the investment schedule, causes an upward shift in the aggregate demand function. It is due to a process of multiple increase in equilibrium income due to increase in investment, and how much increase occurs depends upon the MPC, that is marginal propensity to consume. The process of increase in national income due to increase in investment depicts the investment multiplier impacted illustrated below. Depicts investment multiplier impact as illustrated below. So we have this illustration here. We have aggregate demand in saving investment. This is income. There then they will shift from y0 to y1 and y2, which will be explained as above. So in this figure 1.7.2, an increase in autonomous investment by delta shift, this is I, to the aggregate demand schedule from Ci to C plus I plus delta I, means the new one. Correspondingly, the equilibrium shifts from E to E1, and the equilibrium income increases more than propensity from y0 to y1. Why and how does this happen? This occurs due to operation of investment multiplier. Multiplier refers to a phenomenon where increase in investment expenditure will lead to a proportionately larger change or multiple changes in the equilibrium level of national income. The investment multiplier explains how many times the equilibrium aggregate income increases as an increase in income in autonomous investment. So it helps to explain the multiplier effect. When the level of investment increases by a amount, say delta I, the equilibrium level of income will increase by some multiplier amount, that is delta y. The ratio of delta y to delta I is called a multiplier effect, also denoted by K. So we have formula K equals to delta y divided by delta I. So the size of the multiplier effect is given by delta y equals to K multiplied by delta I. So we have shifted the formula. For example, if a change in investment of 200 million causes a change in national income by 6,000 million, then the multiplier will be 6 by 2, that is 3. Similarly, thus multiplier indicates the change in equilibrium national income for each rupees change in the desired autonomous investment. Since the increase in national income delta y is the result of increase in investment I, the multiplier is called investment multiplier. The process behind the multiplier can be compared to a ripple effect of water. Let us assume that the initial disturbance comes from a change in autonomous investment I of 500 units. The economy being in equilibrium, an upward shift in aggregate demand leads to an increase in national income, which in a two-sector economy will be by definition distribution as factor income. There will be an equal increase in the disposable income. So firms experience increased demand, and as a response their output will also increase. The process further continues as the autonomous rise in investment leads to an induced increase in consumer demand and income increases. We find at the end that the increase in equilibrium income per rupees increase in investment is delta y by delta I equals to 1 divided by 1 minus MPC, which is also denoted as 1 divided by MPS, since MPC plus MPS equals to 1. From the above, we find that the marginal propensity to consume MPC is the determinant of the value of the multiplier, and there exists a direct relationship between MPC and the value of multiplier. Higher the MPC, more will be the multiplier, and vice versa. Mark this: higher the MPC, more will be the multiplier, and vice versa. On the contrary, higher the MPS, lower will be the value of multiplier, and vice versa. Since there is a direct, so this is an indirect relationship. The maximum value of multiplier is infinity when the value of MPC is 1, that is the economy decides to consume the whole of its additional income. We conclude that the value of multiplier is the reciprocal of marginal propensity to save. For example, if the value of MPC is 0.75, then the value of multiplier will be as per 2.11 is 1 divided by 1 minus MPC equals to 1 divided by 0.25, that is 4. The multiplier concept is central to Keynes theory because it explains how shift in investment causes changes in business expectations, set off a process that causes not only investment but also consumption to vary. The multiplier shows how shocks to one sector are transmitted throughout the economy. Increase in income due to increase in initial investment does not go on endlessly. The process of income propagation slows down and ultimately comes to a halt. रुक जाता है. Causes responsible for the decline in income are called leakages. Income that is not spent on currently produced consumption goods and service may be regarded as having leakaged out of the income system stream. If the increased income goes out of the cycle of consumption expenditure, there is a leakage from the income stream which reduces the multiplier effect or the effect of multiplier. The more powerful these leakages are, the smaller the value of the multiplier. The leakages are caused due to above. First, progressive rate of taxation, which result in no appreciable increase in consumption despite increase in income. Second, high liquidity preference and idle saving or holding of cash balance and an equivalent fall in marginal propensity to consume. Third one, increased demand for consumer goods being met out of existing stocks or through imports. Fourth one, additional income spent on purchasing existing wealth or purchase from government securities and shares from shareholders or bondholders. Fifth one, undistributed profits of corporation. Then sixth one, part of increment in income used for payment of debts. Then seventh one, case of full employment, additional investment will only lead to inflation. And eighth one, scarcity of goods and services despite having high MPC. So the MPC on which the multiplier effect of increasing income depends is high in underdeveloped countries, but ironically the value of multiplier is low due to structural inadequacies. Increase in consumption expenditure is not generally accompanied by increase in production. Means increased demand for industrial goods consequent on increased income does not lead to increase in their real output, rather prices tend to rise. अब सिर्फ प्राइस बढ़ता है, इनकम वो हिसाब से राइज नहीं होता है. Then we have an important element of Keynesian's model is that they relate to short period equilibrium and contains no dynamic elements. There is nothing like Keynesian's microeconomic dynamics. When a shock occurs, for example, when there is a change in autonomous investment due to some change in some variable, one equilibrium position can be compared with another as a matter of comparative statistics. There is no link between one period and the next period, and no provision is made for the analysis of processes through time. Now we have more examples. In an economy, investment expenditure is increased by 400 CRs and MPS is 0.8. Calculate total increase in income and saving. So by putting the formula, we will get increase in income and increase in saving. Similarly, we have one more where we have to calculate MPC, which is 0.75. Similarly, we have one more. In an economy, investment is increased by 600 CR. MPC is 0.68. Calculate total income, increase and consumption. And we have the last one, that is 12th one. Suppose in a country investment increased by 100 CR, consumption by 10 plus 0.6y, where C is equal to consumption, Y is equal to income. How much increase will take place in the income? So we have to calculate using multiplier effect. So the increase in investment will cause an rise in income by 250 CRs, that is 2.5 times. Now we have determination of equilibrium income, that is 3-sector model. So aggregate demand in the 3-sector model of closed economy neglecting foreign trade consists of 3 components, namely household consumption, desired business investment demand, and government sector's demand for goods and service. First is denoted by C, investment is denominated by I, and the government sector's demand for goods and service is denoted by G. Thus, in equilibrium, we have Y equals to C plus I plus G. Since there is no foreign sector, GDP and national income are equal. As prices are assumed to be fixed, all variables are real variables and all changes are in real terms. To help interpret this condition, we turn to the flowchart below. Each of the variable in this model is a flow variable. So I will try to reduce this. So this is a circular in a 3-sector model. We have product market, government, financial market, factors. we have businesses and households. So we can see all the transactions are going. We will follow goods, goods and services are being sold by businesses, while in the product market, while household purchase it. Similarly, households consumption expenditures through product market goes as expenditure on domestic products which the businesses earns. Businesses then pays taxes to the government, and government incentivize them by giving subsidies. Similarly, taxes are paid by government, by household to government, and government makes transfer payment. Also, government also makes some government purchase through this product market. Similarly, in the downside, we have financial market where the of household savings are turned into investment through the financial market channel. Here also, government borrowings are done, means government dependent on the financial market. The factor payment made from businesses are converted into personal income of the households. Similarly, the services that household takes from the businesses, it makes payment here through the factor market channel, and the businesses render services here. So you can see the earlier chart of circular flow has been little bit expanded, and the same concept is explained by adding more and more components in the models. Then we have the three sector model, three market circular flow of market, which accounts for government intervention, highlights the role played by government sector. From the above flow chart, we can find that government sector adds the following key models to the model. Following key flows to the model. First, taxes on household and business sector to fund government purchase. Second, transfer payments to household sector and subsidy payment to the business sector. Third, government purchases goods and service from business sector and factors of production from household sector. And fourth, government borrowing in financial market to finance the deficits occurring when taxes fall short of government purchases. However, just I will make it little. However, unlike in the two sector model, the whole of national income does not return directly to the firms as demand for output. There are two flows of the household sector in addition to the consumption expenditure. Namely, first the saving flow, means some part is saved, and the second is the flow of tax payment to the government. These are actual leakages. The saving leakages flow into financial market, which means that the part that is saved is held in the form of financial asset, say currency, bank deposit, bonds, equities, etc. The tax flow goes to the government sector. The sector which occurs in the household sector does not necessarily mean that the total demand must fall short of output. There are additional demands for output on the part of the business sector itself for investment and from the government sector. In terms of the circular flow, there are injections. The investment injection is shown as a flow from financial market to the business sector. The purchases of the investment goods typically financed by borrowings are actually the firms in the business sectors themselves. Thus, the amount of investment in terms of money represents an equivalent flow of funds lent to the business sector. So, the three sector Keynesian model is commonly constructed assuming that government purchases are autonomous, means not dependent. This is not a realistic assumption, but it will simplify our analysis. So, determination of income can be also explained with the help of aggregate demand and aggregate supply. As per figure 1.2.9, we will see it. AD equals to C plus I plus G, and AS aggregate savings equals to consumption AD equals to C plus I plus G, and AS equals to C plus S plus T. The equilibrium national income is determined at a point where both aggregate demand and aggregate supply are equals, that is AD equals to Y equals to AS. So C plus I plus G equals to Y equals to C plus S plus T. So here we have a figure for that. So determination of equilibrium income, 3-sector model. So we have 3-sector. We have expenditure here and income on this side. And on this is the equilibrium point. First line denotes I and second denotes G, and the difference between first and second is delta Y. Similarly, we have one more graph where we have injections or leakages on the y-axis and income output on the x-axis. So we have income in output in both the case on the x-axis. Here is some brief about the above paragraph. The variables measured on the vertical axis are C, I and G. The autonomous expenditure components, namely investment and government spending, do not directly depend on incomes and are exogenous variables determined by factors which are outside the model. You may observe that in panel B of the 1.2.9, the lines that plot these autonomous expenditure components are horizontal, as their level does not depend on Y. So you can see here, these are horizontal. These line. Therefore, C plus I plus G schedule lies above the consumption function by a constant amount. The line S plus T in the graph plots the value of saving plus taxes. This schedule slopes upward because saving varies positively with income. Just as government spending level of tax receipts T is decided by policymaker, the equilibrium level of income is shown at the point E1 where the C plus I plus G schedule crosses the 45-degree line and aggregate demand is therefore equal to income, that is Y. In equilibrium, it is also true that the S plus T schedule intersects the I plus G horizontal schedule. We shall now see why other points on the graph are not points of equilibrium. Consider a level of income below Y. We find that it generates consumption as shown along with the consumption function. When the level of consumption is added to the autonomous expenditure, that is I plus G, aggregate demand exceeds income, that the C plus IG schedule is above the 45-degree line. So equivalently at this point, I plus G is greater than S plus T. That can be seen in the panel B in the figure 1.2.9. With demand outstripping in production, desired investments will exceed actual investment, and there will be a unintended inventory shortfall and therefore a tendency for output to rise. Conversely, at level of income above Y1, output will exceed demand. People are not willing to buy at all that is produced. Excess inventory will accumulate, leading businesses to reduce their future production. Employment will subsequently decline and output will fall back to the equilibrium level. This is only at Y that output equals to aggregate demand. There is no unintended inventory shortfall or accumulation, and consequently no tendency for output to change. An important thing to note is that the change in total spending followed by changes in output and employment is what will restore equilibrium in the Keynesian model, not change in price. Then we have 2.6.1, the government sector and income distribution determination. We have seen above the government influences the level of income through taxes, transfer payments, government purchase and government borrowings. A comprehensive discussion on the effect of government fiscal policy is beyond the scope of this unit, and therefore we shall look into few variables. First, income determination with lump sum tax. We assume that the government imposes a lump sum tax, that is, tax that does not depend on income, has a balanced budget, that is G equals to T, and also that there are no transfer payments. The consumption function is defined as C equals to A plus B into Y multiplied by D, where YD equals to Y plus T, that is disposable income, and T equals to lump sum tax. Therefore, Y equals to A plus B multiplied by Y minus T, that is YD, plus I plus G. I means investment, G means government expenditure. Again, the formula is little bit changed. So Y equals to 1 divided by 1 minus B multiplied by A minus BT plus I plus G. So it's a basic formula you can see in the above case. Suppose we have the following data about simple economy. C equals to 10 plus 0.75 YD plus I plus G plus T, where C is equal to consumption, I is equal to investment, YD is disposable income, G is government expenditure, and T is tax. Find out the equivalent level. What is the size of multiplier? So simply putting it in this formula, Y is equal to C plus I plus G. We get the equivalent value as to 60, and the multiplier by using 1 divided by 1 minus MPC equals to 4 times. Similarly, we have one more point. Income determination with lump sum tax and transfer payments. Here transfer payments are added. So simply we will be adding in this YD part, we will replace it by Y minus T plus TR. TR refers to transfer payments. And similarly it has been explained again and again. We have numerical for the same. We have C value. We want to find the equilibrium value, which comes out to be 1450. We have then third part, income determination with the tax as a function of income. So in 1 and 2 we analyze the effect of balanced budget with the autonomous lump sum tax. In reality, the tax system consists of both lump sum tax and a proportionate. Lump sum means a fixed tax, proportionately based on some proportions, could be income percent, value percent. The tax function is defined as T equals to T bar plus T multiplied by Y, where T bar equals to autonomous constant tax, small t denotes income tax rate, while big T denotes total tax. So the consumption function is C equals to A plus B multiplied by Y minus T, which is disposable income, where YD equals to Y minus T or Y minus T bar minus T multiplied by Y. Simply this is a small calculation. Again we have an example on it. I am just going it little faster because you can solve it by your own. So we have Y equals to C minus I minus D. We have to calculate the equivalent price and multiplier similar to earlier, which comes to 440.91 in our first point, and the multiplier is 1.82. Then we have fourth case, income determination with taxes, which tax as a function of income, government expenditure, and transfer payment. So we have 3 variables here. So now the C will be little bit expanded, where Y will be equals to A plus B multiplied by Y minus T bar minus T into T multiplied by Y plus transfer payments plus I plus G. There we have a question on it, where we have to find out similarly equilibrium value, which comes to 1500. Then comes the next part, determination of equilibrium income, 4 sector model. So in the 4 sector model includes all 4 macroeconomic sectors, that is the household sector, the business sector, the government sector, and the foreign sector. The foreign sector includes household businesses and governments that resides in other countries. The following flowchart shows the circular flow in the 4 sector economy. In the 4 sector model, there are 3 additional flows, namely exports, imports, and net capital inflow. Mark this, which is the difference between capital outflow and capital inflow. The C plus I plus G X minus M line indicates the aggregate demand or the total planned expenditure of consumer, investor, government, and foreigners, that is net exports, at each income levels. So here is a diagram for into 4 sector part. I will just reduce the. Then we have circular flow in the 4 sector economy. So we will see already there were 3 components: businesses, government, and household, and the fourth is export import part is added, exports imports. So you can see some household consumption expenditure has been imported and some is routed to product market. Similarly, some exports are from the rest of the world are done has been routed through product market which goes into businesses. Similarly, there is some net capital inflow. There is explanation given. I will just try to explain it. So in equilibrium we have y equals to c plus I plus g plus x minus m. So exports minus imports. So the domestic economic trades goes with the foreign sector through exports and imports. Exports are the injections in the national income, while imports act as the leakages or outflow of the national income. Export represents foreign demand for domestic output and therefore are part of aggregate demand. Since imports are not demands for domestic goods, we must subtract them from aggregate demand. The demand for imports has an autonomous component and is assumed to depend on income. Imports depend upon marginal propensity to import, which is the increase in import demand per unit increase in GDP. The demand for exports depends on foreign income and is therefore exogenously determined and autonomous. Imports are subtracted from exports to derive net exports, which is the foreign sector's contribution to aggregate expenditure. Since import has an autonomous component M and is assumed to depend on income Y and marginal propensity to import M, the import function is expressed as M equals to M bar plus M multiplied by Y. Marginal propensity to import M equals to delta M divided by delta Y is assumed to be constant. As noted above, the equilibrium level of national income is determined at the level at which aggregate demand equals to aggregate supply. As the aggregate demand AD in the 4 sector model is given in the 2.1.4, the equilibrium condition is expressed as above, where y equals to c plus I plus g plus x minus m, where c equals to a plus b multiplied by y into t and m equals to m bar plus m multiplied by y. The equilibrium level of national income can now be expressed by y equals to c plus I plus g plus x minus m, y plus a plus b multiplied by y minus t plus x plus g plus x minus m, that is import minus export, plus minus m multiplied by y bar. So similarly we have some more derivation here. Then the economy being in equilibrium, suppose exports of country increases by delta y autonomously, all other factors remain constant. By incorporating the increase in exports by delta x, the equilibrium equation of the country can be expressed as above. Here y plus delta y equals to 1 divided by 1 minus b plus m, and the whole is multiplied by a minus b into t plus I plus g plus x minus m bar, mark this, plus delta y, or we have more derivations there, and by arranging it in a different way we get delta y divided by delta x equals to 1 plus 1 divided by 1 minus b plus m, or alternatively delta y divided by delta x equals to 1 divided by 1 minus b minus m. The term 1 divided by 1 minus b plus m is known as foreign trade multiplier, whose value is determined by marginal propensity to consume MPC, that is denoted by B, and marginal propensity to import, which is denoted by M. So this one is here and this one is here. If in the model proportionately income and government transfer payments are incorporated, then only the denominator of multiplier will change. If income tax is of form T equals to T bar plus T multiplied by Y, where T bar is constantly lumps of T is the proportion of income tax and TR is greater than 0, and autonomously, then the four sector model can be expressed as Y equals to C plus X plus G plus X minus M, where C equals to A plus B multiplied by Y minus T bar minus T into X Y plus TR. Where we have explained it, then M equals to M bar plus small m multiplied by Y bar. So the equilibrium level of national income can be expressed as above. You can see this. With the help of above figure, we shall explain income determination in the four sector model. So here is the example: determination of equilibrium income in four sector model. So we have injections and leakages downside and aggregate income and expenditure. This is a equilibrium point in both case. And first line denotes C plus G plus X minus M, and second line, this one denotes C plus I equal C plus S plus T. Then we have some explanation on this. So equilibrium is identified as the intersection between C plus I plus G plus X minus M line and 45-degree line. The equilibrium line is Y. From panel B, we find that the leakages S plus T plus M, this one, are equal to injections I plus T plus X here only at equilibrium level of income. I just marked earlier. We have seen from the above that only net exports X minus M's are incorporated into four sector models of income determination. We know that injection increases the level of income and leakages decreases. Therefore, if net exports are positive, that is export is greater than import, then there is net injection and national income will rise or increase. Conversely, if X is less than M, then there is a net withdrawal and national income will decrease or decreases. Similarly, we have one more figure, 1.2.12, where effects of on income when imports are greater than exports, the first case. So we have points here, this one, this is Y0, we are going this way. So we have seen in section this about the equilibrium income is expressed as a product of the term Y bar plus X, the level of autonomous investment expenditure and investment multiplier. The autonomous expenditure multiplier in the four sector model includes the effect of foreign trade transactions and is stated as above, where M is the proportionality to import, which is greater than 0. You may recall the multiplier in the closed economy, that is denoted by 1 divided by 1 minus B. The greater the value of M, the lower will be the autonomous expenditure multiplier. You can see inverse relationship. The more open to an economy is to foreign trade, the higher M is, the smaller will be the response of income to aggregate demand shocks, such as change in government spending or autonomous change in investment demand. The higher the value of M, the larger the proportion of this induced effect on demand for foreign, not domestic or consumer goods. The increase in import per unit of income constitutes an additional leakages from the circular flow of domestic income at each round of the multiplier process and reduces the value of the autonomous expenditure multiplier. So an increase in demand for export of a country is an increase in the aggregate demand for domestically produced output and will increase equilibrium income just as an increase in the government spending or an autonomous increase in investment. So in summary, an increase in the demand for a country's export has an expansionary effect on equilibrium income, whereas an autonomous increase in import has a contractionary effect on equilibrium income. However, this should not be interpreted to mean that exports are good and imports are harmful in an economic effect. Countries import goods that can be more efficiently produced abroad, and trade increases the overall efficiency of the worldwide allocation of resources. This forms the rationale for attempt to stimulate the domestic economy by promoting exports and restricting imports. So we have some numerical example. We have consumption function given, and we have to find out the equilibrium level of income. Net exports if exports were to increase by 6.25 times. So we have net exports. So exports increase by 6.25. So we have to just change this value, and we again have net exports. Similarly, one more question, we have to calculate trade balance and foreign trade multiplier. So you can solve this one. This is the earlier formula only. Y equals to C plus G plus X minus M. We get the Y, and trade balance equals to, this is the important part, export minus import, which comes to minus 20. So there is a trade deficit, and we can calculate multiplier using this formula, which we get 6.66 times. So here is the conclusion. According to the Keynesian theory of income and employment, national income depends upon the aggregate effective demand. If the aggregate effective demand falls short for that output at which all those who are both able and willing to work are employed, it will result in unemployment in the economy. Consequently, there is a gap between the economy's actual and optimal output or optimal potential output. On the contrary, if the aggregate effective demand exceeds the economy's full employment output, that is production capacity, it will result into inflation. Nominal output will increase, but it simply reflects higher prices rather than additional real output. It is not necessary that the equilibrium aggregate output will also be in the full employment aggregate output. It is undesirable and a cause of great concern for the society and government if the larger number of people remain unemployed. So, in the absence of government policy to stabilize the economy, incomes will be unsustainable because of the instability of investments. By making appropriate changes in government spending, that is G, and taxes, the government can counteract the effect of shift in investment. So appropriate changes in fiscal policy by adjusting government expenditure and taxes could keep the autonomous expenditure constant and even in the face of undesirable changes in the investment. So here is a summary for that chapter. You can go through this. I have already recorded another video earlier which covers this all the chapter summary part, which you can view later for your reference. Then we have MCQ. Also, I have recorded a shorts where I tried to just compile all these MCQs and just rearrange the MCQ answers below the questions, so it will help you for better reading purpose. So thank you for this video. Keep learning and bye bye.